Is the stock market crashing, or are you really afraid it's about to? Then here's 7 different steps that you can take in order to either prepare for the crash or even maybe profit on the way down. At the very least, hopefully, you can protect your portfolio. What's up, my Milk Money Millionaires? I'm Joshua. Welcome to my channel where we learn how to make our money, make more money. In this case, hopefully, lose less money. I'm not a professional financial advisor. I'm just a YouTuber who loves making edutainment videos about the stock market and personal finance. So, invest at your own risk. As the old adage goes, time in the market beats timing the market. And really, if you could time the market perfectly, you would be so rich, it would be insane, right? Obviously, it's extremely hard to do, and you can't really count on doing it. And Peter Lynch always claimed that people lost more money trying to predict crashes and waiting for crashes than they actually lost during the crash themselves. So I do believe the best thing to do is buy investments that you don't mind holding for a long period of time, especially if they got dividends and other income coming off of those investments, so you can sleep easy at night when it crashes. However, nobody likes to lose money when the market crashes. Even if you've got a good long-term 10-year portfolio, it still sucks. So here are some things that I've come up with for how I'm preparing for when and if the market crashes. I do believe we are in a very dicey scenario here. I've been worried for the last several months because our market has seemed way too rich. The PEs of almost even value companies are insanely high. Johnson & Johnson is even at a high valuation. Johnson & Johnson, for Christ's sake. I mean, granted, they got the vaccine hype and stuff, so maybe that's why, but that's a blue chip, super mega cap player, and they're at a PE of like 30 or some crazy crap like that. So when you see stuff like that, you start to get a little worried about the market. And so I've been trying to prepare for a possible crash. But at the same time, you've got a market that's going nuts, so it's hard to totally be out of it. So here's some things that I'm doing. The first thing to do is to prepare. So again, you have to decide what your risk tolerance is and how much you want to hold through and how much you want to time a market, okay, before we do all this. So the first step, if you think a crash is coming some point. So this is me over the last several months, realizing that the market is way too overbought. The market is way too rich. There's lots of signs of euphoria. However, as you saw in the dot-com bubble, that euphoria could last for a long time. So you don't want to totally miss out. But you do want to start preparing. The longer a epic rally like we had in 2020 lasts, the longer that rally lasts, the more you need to start preparing for some type of major correction. So if you think a crash is coming at some point, you want to dial back your risk. So I sold a lot of my risky stocks that I had made a lot of profit in, like Facebook and things like that. I sold it luckily when it started getting beat up in December. Now, normally a stock like that you'd want to hold for a long period of time and not really time it, but with how nervous I was, I decided to scale back a little bit on some of my growth stocks. Some of the other things I was doing was buying options in stocks that were really doing well. It was kind of the FOMO getting to you where you're just like, you know what, this market's going crazy. I got to make a little extra money. So you start buying calls. Now, if you don't want to sell all your stocks, that's okay because you can wait till you're actually in a market crash. But calls are going to get hurt 10 times as bad as your stocks. So if you're afraid of a market crash, maybe don't sell all your stocks, but at least sell all your calls and maybe stop writing puts. Definitely in the future, I would recommend anytime you anticipate some diciness or the market is just too good to be true, dial back on the options. The second main thing you need to do before a crash, whenever you're nervous, is which stocks are you willing to hold through a downturn? Because essentially, when the market starts dipping and you start getting scared, you're going to want to sell. And as we know, it's not good to sell during a crash, right? You want to sell before or maybe in the beginning, but if you're selling at the bottom, it really hurts. So you want to know which stocks are you willing to hold. So if you're willing to hold it through any kind of pain, then you can just kind of shut off the computer, go away for a week, let the market crash, not have to worry about it, okay? But if the stocks that you have are not good enough to hold during a crash, maybe they aren't worth holding at all. So stocks like NIO was a stock that some people really believe in. For me, I was just trying to play some of the momentum. I think it's overvalued. So I was like, you know what? I don't want any NIO in my portfolio anymore if the market were to crash. But I have Realty Income, which I've held for 12 years, and I'm never selling. I've got Pepsi. I'm up 130% on Pepsi from when I bought it like 10 years ago. I'm never selling Pepsi. So you know what? If Pepsi crashes, I'm not going to like seeing it go down, but I'm not going to care. So I don't even have to worry about it. So find out what in your portfolio are you going to hold forever? What do you need to get rid of that you would not be willing to hold through a crash? All right, second step is to watch what factors, macroeconomic factors, will help you understand when market crashes might be coming. Now, again, it's impossible to really truly predict when a market crash can happen. However, usually there's different catalysts that are affecting cycles differently. Like right now, it's the rising 10-year treasury yield that is really putting a lot of pressure on stocks. So if I'm afraid of a crash because of that, then I need to really be up on understanding the yield curve and how that's going to affect stock prices. Now, if you have a more risky stock that you're really afraid to get rid of, then maybe, and you want to hold it, but you're really scared, then you could buy a few puts to protect some of your risky stocks so that if it does crash, you don't have to feel as much pain. I bought some Palantir on the dip recently, and I don't necessarily want to sell them because of a market is dipping, but if I think that Palantir is going to dump even more, maybe I'll buy a put or two so that way I can feel perfectly fine holding Palantir. And then at worst, I'm breaking even. As the stock goes up, put goes down, stock goes down, put goes up. So you kind of protect your position. All right, and the last thing you need to do before a market crash is, or even when a market crash is starting, is come up with your crash buy list. What are the dream stocks that you want to own that you think maybe are too expensive? So these are the great long-term dividend stocks that their yields are going to double. For instance, if Verizon were to drop to like 30, that would be a dream stock because you could buy that at like a 7-8% dividend and hold it for the rest of your life. Also, stocks that are like Salesforce or Zillow, Apple, Microsoft, some of my favorite big growth stock companies that I would love to buy and hold forever, but I'm really afraid to buy at these epically high prices that they've had over the last few months. If the market crashes and I can get Zillow for like $60 again, holy crap, I'd be loading up. So have a crash list so that if the crash is fast and it doesn't last long, you know what deals to be looking out for. If you really get nervous and you really think a crash is coming, or it's like this week where it really feels like a crash might be here or a major correction might be here, then you can start buying what is the UVXY. So the UVXY is based on the VIX, which is, the VIX measures the volatility. So if a market crashes, it doesn't matter what's crashing, what's happening, you're usually going to get a big spike in volatility. So the UVXY will profit off of that spike in volatility. Now, you don't want to buy and hold UVXY forever because the way it's worked with options and there's decay, that the price will go down over time, period, and it'll just rot away and it'll eventually rot away to zero. So you kind of just want to buy it when it's low maybe, or you've made a lot of gains and you want to protect it. But as you can see, the UVIX here in March, if you would have been seeing, oh crap, I really think this market's starting to crash here, right? So you're hearing all the COVID news, your portfolio's down a big chunk already maybe, and UVIX has jumped all the way up to 22. It's already kind of doubled. You're like, you could probably have jumped in right here after the market's already crashing, so you don't even have to like buy it too early, and you still could have made 5x your money here as it rallied all the way up to 140. You could have returned 20 to 140. That's going to help cushion the blow, especially if you're going to ride it out holding the quality companies that you like. So if you don't want to sell your Apple, but you want to profit off the decline and protect your portfolio, then keep your Apple because you already determined that it was a buy and hold stock, and buy some UVXY so that you can actually profit off the downturn and protect your portfolio. Especially if it looks like the crash is confirmed, then you could be more aggressive with buying. So the problem with buying short ETFs or buying puts is that if the market keeps rallying, you're going to lose money. So like if the market dips a little and you get scared, you're losing money on the dip, and then you buy a bunch of shorts, and then it comes back. Now you're losing money on the rebound. So you definitely don't want to too crazy on buying these inverse ETFs and puts unless you really know that you are in a crash. So in March, come around like March 12th, yeah, you're in a crash here. So now you could be a lot more aggressive with buying these inverse puts or inverse ETFs and maybe even buying puts. So that's the next way to play it, is buying puts on the highest beta stock or on indexes. So for instance, I bought some SQQ, which is the inverse of the NASDAQ, because they are getting hurt the worst. And then like today and tomorrow, if we keep being red, then I'm going to start buying some puts on QQ because the puts are going to go up dramatically as the QQQ crashes. And the reason I keep saying SQQ is because NASDAQ has led the market forward. So you want to figure out what has been the high beta stocks, are stocks or indices, if it's a high beta indices, are ones that are doing better than the broad market. So if the average stock is going up by 10%, a beta of 2 would be going up like 20%, right? It's double what everything else is going up. So something like Tesla, you buy a put on Tesla because it's a super high beta stock, you're going to make a ton of money when it crashes. Or the NASDAQ has gone up more than S&P, so it's going to crash more than S&P. So if you buy puts on the NASDAQ, you're better off than on the S&P. All right, once the crash gets really ugly and you're in the middle of March and everybody's panicking, there's blood in the streets, so to speak, you've already lost a lot of money in your portfolio, or you hedged and you didn't lose that much, but like your Apple's way down, your dividend stocks are way down, all your safe stuff's way down. Don't panic now. Once you've already lost money, it's over as far as selling goes. If you can sell early, great. If you can sell before, great. If you can sell in the first wave of the panic, great. But once you're fully in the thick of a crash, you might as well just ride it out, because the worst thing to do would be to sell the bottom and then you lost money on the way down. Now you got to buy your favorite stocks at 20% higher as the market goes back up. So once you've already lost money, hold the good stuff. Hopefully you had some of those inverse ETFs to kind of give you some cash on the way down. Now we're getting close to where it's shopping time again. So if you haven't already updated your crash buy list, you haven't already picked your favorite stocks, now's the time to definitely update it. What's on sale? So maybe a stock like Verizon only went down 5%, even though that was on your buy list, but another stock that you really like Apple, is down 70%. You definitely want to buy some Apple. So go through and see what got killed and what you want to start picking up as the crash is real and it's really getting scary. Make sure you know what you want to do. And then we get into bottom fishing territory. So the next hardest thing to do, is predict the crash. The second hardest thing to do is predict the bottom. So you're probably not going to do it. But at some point when people are panicking and the prices are just so good, you might want to start considering bottom fishing. Now, I would not dump your whole portfolio in when you think it's bottom, because you might only be halfway. You might be catching a bottom, a fall. So, but one way that you can protect yourself here is to figure out on your buy list what are good fundamental prices for your company. So a quick, easy way to do that is to subscribe to something like Morningstar, where you can get an analyst estimate of a fair value. Granted, that value could be ranging based on all sorts of factors, so it's not an automatic value. Use their price estimates just to give me a ballpark, and then try to do my own DCF to try to figure out what else I think it could be worth. But if you start to see these fundamental prices, let's say, so Cisco is a great quality dividend company. They estimate that its fair value is 55. So right now it's at 80. It might be a little bit overvalued. So if the market crashes to 55, you might be starting to get to where you feel like you're bottom fishing. But if it starts getting way below 55, then you could feel safe, because even if you did not buy the bottom, but Cisco is at 30, when its fair value is 55, then you're not going to get too burned in the long term, because even if the market keeps crashing, it should eventually get back to its fair value. So that's one way to start thinking about when you want to buy in. But you definitely want to buy in when everybody else is panicking. And one other safe way that you can buy in is to sell puts. So once you're like, man, this is the bottom, I really want to start buying, but I'm scared. This is a kind of a measure of the volatility. So when a market is crashing, the volatility is insane. So if you think a stock is at $50, and it was down from 100, and you're like, I think this is the time to buy, but I'm afraid it's going to go to 25. You could sell a put at 50 or maybe 40, 30, whatever, because there's so much volatility. You're going to get paid so much for selling a put after a market crash that you're giving yourself a ton of downside protection. And then if the stock goes up, you get to just keep that premium, so you don't really miss the bottom. So once you think it's the bottom, start selling puts as your first way of getting back into the market. Then after you feel like the bottom is really in, the market's turned back up, and you feel a little bit safer, and the prices are going up, then you can start actually buying stocks. I would not buy options until you know the market's really ready to roll. So what I like to do whenever there's a crash is figure out what were the stocks that were hit the most. Back in 2008, when it was housing, I bought REITs and stuff, whatever. I bought Ford because Ford was almost out of business. What got absolutely murdered that you think is going to survive? Buy those first, because you can make so much return as those just get back to normal. But anyway, that's some things to think about. Right now, seeing the market go crazy, I think we might be getting ready for a heavy correction. And so I've already bought some hedges to protect myself. And what's funny, if you buy enough hedges, you start rooting for the crash, because crashes are when you get great stocks on sale. And if you want to learn more about great stocks on sale as they become on sale, hopefully, then subscribe to this channel, like the video. But anyway, thanks so much for watching. Again, I'm Joshua. We'll see you in the next video.